Today, we are diving deep into a question that honestly underpins the entire global financial system. What is the future of the US dollar? For decades, it's been the bedrock, the one unshakable foundation. But right now, we're seeing a perfect storm. You've got unprecedented debt, massive geopolitical shifts, and just incredibly volatile market forces, all creating this fundamental tension. So is the dollar caught in a kind of death spiral of its own making? Or, and this is the fascinating part, could a global crisis paradoxically be the one thing that makes it even stronger? Let's get into the data and the theories that are going to decide the answer.
So here's how we're going to break this down. First, we're starting with the cold, hard numbers, what we're calling the $2 trillion interest trap. Then we'll take a step back in time to look at a pretty chilling historical parallel. After that, we'll dig into the powerful counterargument, the dollar milkshake theory. From there, we'll explore 3 possible scenarios for how this whole thing could play out. And finally, we'll look at how the smartest money in the world is getting ready for whatever comes next.
All right, let's start with the math. Because before we can get into any of the big theories or the geopolitics, we have to understand the stark fiscal reality the United States is facing. And frankly, that reality is just staggering.
$2 trillion. I just want you to let that number sink in for a second. Now remember, this is not the total national debt. This is just the annual interest payment to service that debt. It's the yearly fee. It's a figure so massive it's hard to even comprehend, but it represents a fundamental break from anything we've seen in history. And it's a huge constraint on every single policy decision from here on out. This one number is the engine driving all the uncertainty we're about to explore.
But it's not just the size of the number that's shocking, it's the sheer velocity, the speed of the change. This is not some slow-moving problem that's decades away. It is an explosion happening right now. Think about it. Back in 2020, interest payments were about $350 billion. Manageable. By 2024, they tripled to $1 trillion. And the projection for 2026? $2 trillion. That is a 470% increase in just 6 years. A trajectory like that is, by any definition you want to use, completely unsustainable. So what's the actual mechanism behind this?
The answer is something called the refinancing cliff. See, during the pandemic, the U.S. issued trillions of dollars in debt at almost 0% interest. Great deal, right? But here's the catch. That debt has an expiration date, and with an average maturity of around 6 years, all of that super cheap debt is now rolling over. It has to be refinanced at today's much, much higher rates. It's like a mathematical conveyor belt. Every old, cheap bond that expires gets replaced by a new, very expensive one. And this isn't a policy choice, it's already baked into the cake, locking in higher costs for years to come.
Okay, so this fiscal crisis, it doesn't exist in a vacuum. History offers a really powerful and, frankly, a pretty sobering precedent. To understand where the U.S. might be headed, we really need to look at the last global reserve currency that found itself in this exact same predicament.
And the parallels, they're just striking. In 1945, London was the center of the financial universe. The pound was the reserve currency, but Britain was completely bankrupt from the war, with a debt-to-GDP ratio of 250%. At the same time, its economic bloc, their system of trade within the empire, was falling apart. Now, fast forward to today. The U.S. has the reserve currency, its debt is on a very similar disastrous trajectory, and its own economic bloc, the petrodollar system, is showing some serious cracks. So what happened to the pound? Well, it lost 90% of its value over the next few decades. This isn't just history rhyming. It could very well be a blueprint for a global transfer of power.
So, given the math and the history, the conclusion seems pretty obvious, right? It looks like a dollar collapse is almost inevitable. The debt trap seems like a death sentence. But what if it's not? What if there is another, equally powerful force pushing in the exact opposite direction? And this brings us to the great counter-argument in this entire debate, the dollar milkshake theory. It is a powerful, totally counterintuitive idea that completely flips the script on what a dollar collapse could look like. The core idea is this. The dollar's biggest weakness, the fact that the entire world is drowning in dollar-denominated debt, is also its greatest short-term strength. See, the world isn't just long U.S. assets. It is effectively short the U.S. dollar. There are trillions in foreign debt that have to be paid back in USD. So in a global crisis, what does everyone on the planet suddenly need to get their hands on? Dollars. This creates a desperate, panic scramble for dollars. The metaphor is a milkshake. The U.S. is the only one with a straw long enough to drink the entire world's milkshake of capital, sucking it all back home and causing the dollar to spike, even as its own long-term fundamentals are absolutely terrible.
So right here, this is the central conflict. This is the heavyweight fight. You have two immense opposing forces acting on the dollar. On one side, pulling it down, you have the sheer gravity of the debt trap, the unsustainable math, the historical parallel with the British pound. But on the other side, pulling it up, you have the dollar milkshake theory, this massive global short squeeze caused by all that dollar debt and a flight to safety in a crisis. The key question for every single investor today is which of these massive forces is going to win? Is the debt trap a slow death sentence, or will it be preceded by a dramatic dollar-strengthening crisis first?
Well, this tension can't last forever. This tug-of-war has to end. One force has to win out. The system has to resolve into a new reality. So let's walk through 3 potential scenarios for how this whole conflict could finally end.
The first scenario is what we'll call the slow burn. This is really the path of least resistance for policymakers. It's the kick the can down the road option. They try to manage a decline by keeping the system on life support through steady currency devaluation. Think maybe 10% inflation year after year. Now, this avoids a sudden chaotic collapse, but it comes at a huge cost. It systematically destroys the savings of the middle class. It's a slow bleeding out of value, a silent tax. The problem is, the sheer scale of that interest trap might make even this controlled burn impossible to manage. It might simply be happening too fast to control.
And that leads us to the second, much more dramatic possibility, the hard reset. In this scenario, the system reaches a breaking point. Maybe it's a failed treasury auction where the U.S. tries to sell its debt and there just aren't enough buyers. This would trigger a crisis of confidence so severe that the only way to restore trust is a full system reboot. This could mean introducing a brand new currency, maybe a digital dollar, but this time backed by something real, like gold, to instantly reestablish credibility around the world. It's a controlled demolition, really, designed to preserve the system by changing its very foundation.
And the third scenario is geopolitical, the fragmented world. Here, the resolution isn't a reset, it's a split, a global financial divorce. The world divides into competing financial blocks. One remains centered on the US dollar, but the other, led by the BRICS plus nations, creates an entirely new system. They start using platforms like the BRICS Bridge to completely bypass the US-controlled SWIFT payment network, and they start to settle trade in new currencies, maybe tokens backed by a basket of commodities, real stuff like oil and gold. This would be a fundamental shift away from a single debt-backed global currency to multiple resource-backed regional currencies.
So after hearing these incredibly high-stakes scenarios, the obvious question is, how on earth do you position a portfolio for this level of uncertainty? What are the strategic moves that the smartest people are making to prepare for this kind of shift?
To really understand the strategy, you first have to get your head around the government's primary tactic, which is called financial repression. With a $2 trillion annual interest bill, the government has a massive incentive to keep inflation running higher than the interest rates it pays on its debt. Why? Because it allows them to pay back their enormous loans with future dollars that are worth less. It's really the only way out that doesn't involve an outright default. But this policy is a devastating stealth tax on anyone holding cash or government bonds because your purchasing power is guaranteed to decline every single year. Suddenly, holding traditionally safe assets becomes an incredibly risky proposition.
So in response to this, sophisticated capital is adopting what's known as a barbell strategy. It's a strategy of extremes. On one end of the barbell, you want maximum safety. This means owning real physical assets that are held outside the traditional banking system. Things like physical gold, productive land, things that can't be devalued by a government with a keystroke. Then, on the other end of the barbell, you seek maximum asymmetry. These are your high-risk, high-reward bets on assets with explosive growth potential, like some of the decentralized technologies that could form the backbone of a whole new financial system. And what's in the middle of the barbell? Nothing. Absolutely nothing. The key is to exit the middle, to reduce your exposure to those paper assets, like cash and bonds that are most vulnerable to this financial repression.
The conflict between the debt trap and the dollar milkshake is going to resolve, one way or another. Whether it's through a slow burn, a hard reset, or a global fragmentation, the financial landscape of the next decade is going to look profoundly different from the last. The strategies that worked in an era of stable money are going to fail in an era of deleveraging. So the final question isn't just for institutions, it's for all of us. Which future are you prepared for?